So, hello everyone. My name is Andrew Byte, and this is my presentation about the accounting analysis of Taylor Swift's Eras Tour. So, for this activity, I selected the Eras Tour because it's a major entertainment industry example with significant financial transactions. Although the public often focuses on the tour's record-breaking revenue, accounting principles help explain how that money is recorded, classified, and reported. So in this presentation, I will discuss 3 major business transactions related to the tour, including ticket sales, revenue recognition, and production expenses. I will also analyze whether the financial portrayal of the tour accurately represents the actual financial performance of the business. So Taylor Swift's Eras Tour became one of the highest grossing concert tours in history. So the tour generated revenue from multiple sources, including ticket sales, merchandise, sponsorships, and other entertainment-related activities. From an accounting perspective, these transactions must be recorded properly to show the company's true financial position. One important example is advance ticket payments. So when customers purchase tickets before a concert occurs, the company receives cash, but it also has an obligation to provide the concert experience in the future. So the tour also generated merchandise revenue through the sale of branded products. So these sales create additional income that must be recorded separately. So finally, the tour has significant production expenses, including stage construction, employee wages, transportation, security, and equipment costs. These expenses must be included when determining the actual profitability of the tour. So in terms of the transaction 1, which is ticket sales revenue, the first transaction involves advanced ticket sales. When fans purchase tickets before a concert takes place, the company receives cash. However, according to accounting principles, this money cannot immediately be recorded as revenue because the performance obligation has not yet been completed. So the journal entry would be debit cash for $10 million and credit unearned revenue for $10 million. $10 million. So cash increases because the company receives payment. However, unearned revenue is recorded as a liability because the company still owes customers the concert experience. So this transaction keeps the accounting equation balanced because assets increased by $10 million and liabilities also increased by $10 million. In terms of the second transaction, which is recording concert revenue. So once Taylor Swift completes the concert, the company has fulfilled its obligation to customers. At this point, the previously recorded unearned revenue can be recognized as earned revenue at this point. So the journal entry would be debit unearned revenue for $10 million and credit concert revenue for $10 million. This removes the liability because the company no longer owes the customer a service. At the same time, revenue increases, which increases equity. And this demonstrates an important accounting principle, that is, revenue should only be recognized when it is earned, not simply when cash is received. In terms of transaction 3, which is paying production expenses, a large concert tour requires significant resources, including stage equipment, employees, transportation, security, and production support. For this example, the journal entry records Debit concerts expenses for $3 million and credit cash for $3 million. The expenses account increases because the company is using resources to operate the tour. Cash decreases because the company pays for these costs. Expenses reduce net income, which also reduces equity. This transaction demonstrates why revenue alone does not determine financial success. A company must also consider the costs required to generate that revenue. So, in terms of the analysis of accounting accuracy, when entertainment companies report financial success, the public often focuses on large revenue numbers. However, revenue does not equal profits. For example, a tour generating billions of dollars does not mean that amount becomes personal income for the artist. Many expenses must be deducted before determining actual profit. Some costs that may be overlooked include production and venue expenses, employee wages, marketing costs, taxes, and management fees. A more accurate accounting analysis uses the formula revenue minus expenses equals net income. By separating revenue, expenses, liabilities, and profit, accountants provide a cleaner picture of the organization's true financial performance. Therefore, the financial portrayal of Eras Tour is accurate when accounting principles are applied, but headlines that only focus on revenue can create an incomplete picture. So in conclusion, Taylor Swift's Eras Tour demonstrates how accounting principles apply directly to the entertainment industry. The first important concept is recording cash receipts correctly. Money received before a concert occurs is recorded as a liability rather than immediate revenue. The second concept is recognizing revenue only when the performance obligation has been completed. The third concept is tracking expenses because production costs, employee wages, and operating expenses reduce overall profits. Finally, every transaction must maintain the accounting equation. Assets equals liabilities plus equity. So accurate accounting provides investors, managers, and shareholders with a realistic understanding of financial success rather than rely only on revenue numbers. And thank you for listening.